Please subscribe for more videos. Click the bell icon for updates.
What is Assets Under Management? AUM, Assets Under Management, is the total market value of the investments that an entity such as mutual fund, venture capitalist firm, or a person or even broker manages on behalf of the clients. Assets under management is sometimes called as funds under management. It is calculated by dividing net asset value of funds by number of units outstanding. This calculated method varies from firm to firm. The investment management companies charge their fees in proportion to the assets under management. The AUM includes capital raised from investors and capital belonging to the principals of the fund management firm. In the calculation of AUM, some institutions include bank deposits, mutual funds, cash, whereas others limit under discretionary management, where the investor authorizes the company to trade on his behalf. AUM of the firm increases when the investment performance is positive or when new customers and assets are brought to the firm. AUM decreases by negative investment performance or withdrawals, including fund closures and other generally adverse events. What is adverse selection? Adverse selection is a situation where the sellers have different information compared to the buyers, or the sellers have the information that the buyers do not have. This may lead to selective trading, where sellers benefits at the expense of the other trader. The party without information worries about the unfair trade and can withdraw from the trade, which leads to the decrease in the volume of the trade. The adverse selection happens in various fields like insurance, healthcare, banking, etc. For example, in insurance, the insurer with a high-risk job and dangerous lifestyle getting the policy without informing the insurance company. In this case, the buyer has more knowledge. To avoid this, the insurance companies reduce exposure to large claims by raising premiums or limiting coverage. What is acquisition? An acquisition is a transaction where one company purchases more than 50% of the target firm's stock and other assets, which allows the acquirer to gain the control of the company and to make decisions about the newly acquired assets without the permission of the company's shareholders. The purchaser is called the acquirer and the company purchased is called target company. In acquisition, both the companies continue to exist as separate legal entities. One of the companies becomes the parent company of the other. Benefits of the acquisitions are reduced entry barriers, market power, new competencies and resources, access to capital, access to experts, fresh perspective and ideas. Disadvantages include different cultures, some key employees may be forced to leave, there may be duplication of work, companies' objectives may conflict, the asset value may be lower than the perceived value. What is abnormal return? The difference between the actual return and the expected return of a security or a portfolio is known as abnormal return. Abnormal return is known as alpha or excess return. This cannot be explained by the market as it is the result of the expertise of the investor. Or abnormal is equal to R actual minus R normal. Normal return is the expected return, whereas the actual return is the correct return in a particular period of time. An abnormal return can be either positive or negative. If the actual return is higher than the expected return, it is positive. If the actual return is lower than the expected return, then it is negative. An investment's abnormal return, whether positive or negative, measures how it was performed over a given period of time. Abnormal returns can help to identify the portfolio manager's skill on a risk adjustment basis. Abnormal returns are sometimes triggered by the events. These events can include mergers, dividend announcements, company earnings announcement, interest rate increase, lawsuits, etc.